Hey everyone, welcome to our perpetual video on time value of money. So in this specific video, we're going to focus on one objective, and that is making the adjustment to annuity dues, right? We've already dealt with our ordinary annuities. Now we'll make the adjustment to annuity due and also understand the concept of perpetuities. What do we mean by a perpetuity? So annuity dues, well, we remember that the annuity is a periodic cash flow, but important to remember when we're referring to annuity dues, we're actually making that cash flow payment or investment at the beginning of the period. Okay, so previously we were always mentioning or calculating ordinary annuities. And those ordinary annuities, we can see by the timeline, it was always those payments or those investments were made at the end of the period, okay, as you see here. What does that look like for annuity dues? Well, we're making payments at the beginning of the period. So as you can see, we have to start our payments, and yes, we get to finish a little bit earlier. And in both cases, you can see there's still 4 deposits being made. But of course, we understand by now that in time value money calculations, the timing in which those payments are made affects the value of that investment. What does this look like for us in terms of making the adjustment? Well, if you're using a financial calculator, it's important to be on the right mode, right? So if we're dealing with annuity dues, we need to change our calculator to beginning mode. Typically, the end is the default, so it's important to make sure you're on the beginning for an annuity due. With our spreadsheet, Excel specifically, when you do punch in your formulas, again, you'll see that option between type 1 or 0. Type 1 is annuity due, so if we are dealing with annuity dues, it's important to make sure you're using that type. So that's a nice disclaimer for you. Let's look at an example that compares both annuity dues versus ordinary annuities. So our premise here is that we're going to save for retirement, and we're going to make those equal payments of $3,000 for the next 20 years. And we're going to do it in an account that pays an interest rate of 8%, right? So we want to know what is really the difference. Okay, so by how much will your accumulated nest egg vary? What will be the difference if we make each of the 20 deposits at the beginning of the year? So remember, what does it mean to make a deposit at the beginning of the year, starting right away? That's yes, annuity due, right? Versus the ordinary annuity, which is when we make a payment at the end of the next 20 years. Okay, so just a reminder, the difference, let's look at it mathematically. So for the ordinary annuity, we can use our future value. We're going to use this equation in both regards. But one thing is important with the future value of annuity due is that we need to add on the future value, one additional future value. So we actually get a little bit more value by paying at the beginning of the year rather at the end of the year. Okay, so we have more earning potential if we pay at the beginning of the period. And it really just illustrates the value of investing earlier. The sooner you save, the bigger the payout. So that's just a reminder on making sure that we make the proper adjustment, okay, particularly in your calculator or your spreadsheet, and understand what the difference between annuities and annuity dues are. Let's now discuss perpetuities. Okay, so these are still annuities. The difference is with perpetuities, and as the name suggests, it's that it's an equal cash flow that just never ends. It goes on forever, right? How do we solve for the present value of a perpetuity, you might ask? Well, it's probably one of your favorite equations. It's very simple. Okay, so we're going to take that payment, so whatever equal payment we're going to be getting forever, and we divide that by the interest rate. That's going to give us the value of that perpetuity. And why is that important? Well, it's important for us to understand so that we can determine whether or not we should invest in such an option. So let's look at an example here. Perhaps you want to buy one of these perpetuities. So a console is really just a perpetual bond. Okay, so it's just basically issued out by the government. It's an option if you want to invest in something like this. And basically you purchase this console or this bond, and what will happen is that you will get paid out every single year. So you'll get a payment, and that payment stream is a perpetuity, so it goes on forever. So really the question is, most often is, what is the right price that you should be willing to pay for this, whether or not it's worth it or not. Okay, so in this case, if we want to earn an interest rate of 10%, well, we can simply use the formula that we just used. Okay, so again, that if we know our rate is 10% and the payment is $60, if we divide the payment over R, we will get a present value of $600. Okay, so that's how much we should pay. If we pay more than that, then we're going to get a lower interest rate. Okay, so that's really depending on what your goal is in terms of the rate. Okay, but this is a very excellent, simple way to value an asset like this. And we'll talk more about valuing assets as we continue. But just remember for now that what we mean by never-ending stream of equal periodic payments is called, well, I think you'll figure it out. Wonderful. Well, thanks for watching. Happy financing, and we'll see you at the next Time Value Money video.